And just a reminder, FCT. Okay, how are we going to mark the sales? Which way? What kind of rate? Starts with an A. Average. I'll do that during the test. Come around. Can you imagine though if I gave you like the wrong letter or you just couldn't? Now, we remember in this FCT method, if you went through the notes, your calculation for cost of goods sold or cost of sales is different because our beginning inventory is at one rate. Purchases are at another rate, our ending inventory is a different rate. So we have to do a separate calculation for this. And of course, gross profit is just a calculation. Now, operating expenses. What do you think operating expenses are at, based on the information they gave you? Average. Except depreciation. Now, for FCT, it's when the asset is acquired. Okay? So, we have to separate out depreciation because it's not a, if you've done the question, it's so much of an easier method. Okay, so let's do that right now. Depreciation, somewhere, here. Third bullet point, last sentence. Depreciation expense. So this operating expense should only be $3,400. So we're going to say less depreciation of 1,000. And depreciation has, well, because it's when the asset's acquired, not average. So let's squish depreciation in down here. And that's going to be when asset acquired. So our depreciation has to split into two pieces. Let's try doing that. Actually, just before I do that, let's do the interest and taxes since we're here. Average, because it's when it's incurred. And how often do you account for interest? When you're calculating a loan, not doing the entry. Well, every day, right? They don't go, oh, well, you get this week off. So interest is going to be average. These are also going to be average. So let's start putting these rates in, then we'll do the depreciation. Okay, so what's our first rate? 0.031. This is going to be a separate calculation. Gross profit just is its subtraction. Operating expenses are going to be 0.31 because they're average. Interest 0.031 and taxes 0.031. Questions on any of those rates? Is it kind of making sense? Okay. Well, you're looking at first figure out, is it all assets and liabilities that are current? That would be PCT. Or is it just monetary? That would be FCT. Then look for the highlights. Dividends, depreciation, common shares, right? Those are the weird ones you got to figure out what to do with. Otherwise, it's historical. You're good. Okay, so let's deal with the depreciation. So we know depreciation was $1,000. Now we have to split it up. This is for the first asset. So the first one we already calculated at 400. You can draw a little arrow if you want. So how much is the second? 600. Now remember, depreciation under FCT is always going to be the date the asset was acquired, unless it was before you bought it, in which case it's the day you bought it. Okay, so what was the date on this 400? January was 0.075. And the second asset was June 30th, year 2. So that is what rate? 0.62. Good. Sorry, it's a little squished together. So that works out to 30. And remember, it's in thousands. That works out to 37. So together, those go over here to 60. Okay, see what I did there? Can you follow it? It's a little squished. Questions, you guys? I'll start working these numbers out because we've got to deal with this calculation. Generally, you guys, if I do questions, this is the kind of thing I do. I put my rates in first, then I start doing the calculations, looking for weird little things I have to do, like the cost of sales calculation for FCT. Not for PCT, it's easy. So, say we're doing it in thousands, so you should get 626. Now, the cost of sales need a separate calculation. So, I'm just going to use a different page. Anyone still need this? Okay. So, cost of sales calculation. And again, FCT. Cost of sales calculation. So, if you look, this question isn't the same as some of the ones in the book, which have increase or decrease of inventory, I think, and beginning inventory or something. It's different. So, this is you have to think it through and go, what do I do in this situation? All the new stuff is which rates go. Everything else is stuff you've actually learnt, usually in 311 and then carried forward a little bit in 315. So we're going to start with beginning inventory, year 4, and then we're going to add purchases of inventory. We're going to subtract ending inventory. And if we do that, what calculator do we get? You've done this 100 times in other courses. Cost of goods sold or cost of sales. They're the same thing. So remember, these are all historical rates. So what's our beginning inventory? Where are you going to find that? Well, end of year 3 is beginning of year 4, right? So you look at year 3, ending inventory Everybody good? So 3,500. Now, we need to add our purchases. On here, does it say anything about purchases of inventory? No, except purchases were made throughout the year. So I'm just going to do a little T account for inventory to try and figure out what our purchases are. Now, you guys, there's lots of logical ways to think this through. So if you did it a different way, that's totally fine. Okay, if you're going, why didn't you just do this? I'm doing this so when you look back the theory. Okay, so we started with 3,500. Now, what happened during the year? Did we sell some inventory? Yeah, how much? Yes. And that's our cost of sales, our cost of goods sold. So that gives us a balance of 7,800. What should the ending balance be in year 4? 4,800. So I have to fill in the blank and see what number's missing. That's our purchases. So go ahead and do that, you guys, and tell me what you get. It starts with a 12. It's all 600. Great, thanks, you guys. And that is purchases. So 12,600 minus the ending inventory, which we already know is 4,800. And that gives cost of goods sold of 11,300. So you could have just filled that in and gone back and figured out the purchases, however you want to do it, you guys. So that's the stuff from pro and intermediate. The stuff from advanced now is putting the rate, take a second, and put the okay, what rate did you get for beginning inventory? 0.045? Hopefully. What about purchases? How come we can use an average rate for things like purchases and sales? Why don't we use the historical rate for each one? Because that would be crazy, right? You're not going to go back and assess every sales. You're not going to do each one. So that's why we can say average is acceptable. However, if they gave you specific information, then you'd have to do it separately. Okay, so 0.031 because it's an average, and ending inventory 0.027. Which works out to 157.5, 90.6, and 129.6. For 18.5 or 419. So, now that we've done that calculation, we can go back and put that number under cost of sales. Oops. So cost of sales here is $419. And it's from a separate calculation, which means our gross profit we just subtract to get 207. And then you guys, we just multiply these across. So I'm going to 105, 22, 19, and of course the 67, which gives us -6. Now, that is net income before foreign exchange gain or loss. Everybody good? Does it make sense? So the tricky part's in this one, not cost of sales, because you're always going to have to calculate in some fashion if you're doing FCT. This depreciation, you don't often see a split like this. In real life, you do. Carefully. So, with FCT, where does the foreign exchange gain or loss go? Does it go within net income or does it go in OCI? In net income, okay? So we've got to calculate that gain or loss. So on another page, and I'm going to start a clear page. I'll number these pages, scan them, put them up, you guys, as well as the video. Okay, so now we need a calculation for FCT for foreign exchange gain or loss. And again, you guys, the format of this can be whatever you want. Generally, you're just in one number on Connect. Okay, so if you're trying to reference your notes, this is on page 6 of your notes. So I want to get through the FCT and then do the multiple choice. So I'm just going to start going, if that's okay. So we're going to start with the net monetary position, which is just monetary assets minus monetary. And I need the beginning, year 4, the end of year 4. So at the beginning of year 4, always remember that's year 3, so it's the outer column. Don't flip the columns. New ones first, then it goes backwards. Beginning of year 4, we've got cash and accounts receivable, which is 3,900 plus 2,100, which is 6,000. And then current liabilities and long-term debt, 900 plus 6,000 equals 6,900. And it's always assets minus liabilities to get net assets. So we're at negative 900, and that's our beginning net monetary position. The end of year 4, we do the exact same thing. The hardest thing for is the first column. So it's 4,100 plus 2,900, which equals to 7,000. Whoops, got carried away. And then 2,400 plus 6,000 is 8,400. So we end up with negative 1,400. Now, you could have step 1 into step 2. So take whatever shortcuts you want, you guys. Clear. And I'm talking for the CPA when you do that. So let's go with part 2, where we start. Well, first we have the Indian rupees, the exchange rate, and then the Canadian dollar amounts. And we start with beginning net monetary position, which then we add or subtract changes in net income and statement of retained earnings. So that is really all the cash changes. A lot of the questions we just assume cash because I show you how we tie in what you learned from statement of changes in, oh my God, I don't even know, that's the wrong statement. Statement of cash flows. How you did that in 316, what we do here. Okay. So, we know net income consists of a number of things. We've got sales. We've got purchases, and it's only purchases. We've got we've got interest, taxes, and dividends. Okay, so let's assess our sales. If this part, you're not going to see it on the exam, okay, having to split this out like this. But this is a critical piece because it does tie in that this is actually cash. We get a little lazy with the other questions, kind of assume it, but this is what happens. So for sales, we need to convert actual sales to cash. So, well, we know sales were how much? 200. Now, think, wait, if we increase unearned revenue, are we getting extra cash? Yeah. Is it recorded in sales? No, because it's not earned yet. We want to know the cash inflows or outflows if it's decreased. So we have to add or subtract the change in unearned. And you did that in the direct method of the statement of cash flows. So we're going to add the increase in unearned revenue because it went from 500 to 800. Take a second, look at your balance sheet and see those numbers. Everybody got them? So it went up, which means we just increased our sales cash. So that goes to 20,500. So that's going to be 20,500. Now, purchases we're happy with. We already know purchases from our lines. They were 12,600. We already know our operating expenses with no depreciation were $3,400, right? Except, did prepaid exchange expenses change during the... Yeah, they did. They went up. That means we spent more on expenses, or spent more money than it says in the expenses. We had this extra we shelled out for prepaid for future time. Okay? So this is going to be letter B. Operating expenses, convert to cash. So we start with operating expenses. We said it was $3,400, no depreciation. And then prepaid expenses increased from $1,700 to $1,900. So we know there's 200 here. Did we spend extra cash? Yeah. If it would have gone down, some of our operating expenses wouldn't have been cash from this year, it would have been last year's. So I'm going to put spent extra cash. And that works out to $3,600. And in the same way, you guys, this increase in unearned revenue got extra cash. So this question really ties a lot of things together. So you can see kind of how it all fits like a little puzzle. Okay, good taxes is $600 and dividends is $3,500. They're all negative because they're expenses. So now we need the rates for these. What's the beginning net monetary position? What's the rate? It's monetary, so it has to be current on that date. Oh, sorry, thanks. So 0.041. Everybody good? And that equals, now sales is average, so it's 0.031. Purchases is average, 0.031. Operating expenses, 0.031. 0.031 for interest, 0.031 for taxes. Whoops. Dividends is the different one, so be careful with that one. It's when it's declared, 0.025. And of course, you can take shortcuts here, you guys. So, this 391, 112, 22, 19, and 88, which works out to negative 33. But to find our gain or loss, that's what we think it should be. If we take our beginning and all the changes, because the exchange rates aren't applied or the same one to every single number, you're going to get differences. So we're down here going to put ending net monetary position. And we said that was 1,400 from up here, further up. And that rate is going to be 0.025. And that equals negative 35. So missing in, here's the gain or loss.